Few words on a bank statement create as much quiet stress as the phrase overdraft fee. You glance at your account, expect to see a small balance, and instead find a charge that wipes out part of your paycheck. The frustrating part is that overdrafts often happen in small, almost invisible ways, and the fees can quietly cost households hundreds of dollars a year without ever feeling earned. At its core, an overdraft happens when you try to spend more money than your account currently holds. The bank has a choice. It can decline the transaction, or it can pay the transaction on your behalf, essentially making you a very short-term loan. If the bank pays, it usually charges an overdraft fee, often a flat amount, regardless of how small the original transaction was. The first surprise for many beginners is that this fee can be triggered by very ordinary purchases. A coffee, a small subscription renewal, or a recurring streaming charge can quietly slide your balance below zero. The fee for that single small purchase can sometimes be many times larger than the purchase itself. The size mismatch is part of what makes overdraft fees feel especially painful. A useful metaphor is a bucket near the edge of a table. As long as the bucket is comfortably full, water flows in and out smoothly. But if the level falls too low, the next splash can send a small drop spilling over the edge. The bank charges a fee for cleaning up the spill, even though the spill was tiny. The mess does not match the response. There is more than one type of overdraft fee. Some banks charge a standard overdraft fee when they cover the transaction. Some charge an additional daily fee if the account stays negative for several days. Some charge separate non-sufficient funds fees when they decline the transaction entirely. Each policy is slightly different, and many people pay multiple fees without realizing. A common misunderstanding is that overdrafts only happen because of careless spending. Often they happen because of timing. A direct deposit lands one day later than expected. A bill is auto-charged a day earlier than planned. A pending hold from a previous transaction lingers. The math may be right in your head but wrong in the account on a specific day, and the bank charges nonetheless. A hidden risk is the order in which transactions are processed. Some banks historically process the largest transactions first within the day, which could push the account negative sooner and trigger multiple fees on smaller transactions later. Rules have changed in many places, but the basic point still matters. The order of processing can quietly multiply overdraft fees on a single bad day. Optional overdraft protection programs exist at many banks. Some link your checking account to a savings account, automatically transferring funds to cover a shortfall. Some link a credit card or line of credit instead. These services may have their own fees, but they are usually much smaller than a standard overdraft fee. Setting them up once can quietly prevent many future surprises. Another important option is to opt out of certain overdraft programs. In some systems, you can request that debit card transactions simply be declined when the account has insufficient funds, rather than being covered and triggering a fee. The minor embarrassment of a declined card at a register is usually far less painful than a large fee discovered later in the day. Let us look at a real-world example. Imagine someone with a small daily routine of card transactions, a forgotten subscription charging on the same day rent clears, and an upcoming paycheck due in 2 days. The balance dips negative by a small amount. Several pending transactions then settle one after another, each triggering its own fee. A single timing gap turns into multiple overdraft charges by evening. What beginners often misunderstand is that overdraft fees are not random punishment. They are a major source of revenue for many banks. Some institutions have historically earned billions from these fees collectively. This does not make them illegal, and it does not mean every bank operates the same way, but it explains why some banks fight harder than others to keep these programs in place. There is a psychological angle, too. Once an account is overdrawn, many people feel ashamed and avoid checking their balance for a while. That avoidance often makes things worse. More transactions clear, more fees accumulate, Facing the situation early, even when it feels uncomfortable, is the fastest way to stop the bleeding and reset the account before things spiral further. A practical rule that prevents most overdrafts is to keep a small cushion in your checking account that you mentally ignore. For example, treat your usable balance as if it were $100 less than what the screen shows. That invisible cushion absorbs small timing mismatches and forgotten subscription charges. It quietly turns a fragile balance into a sturdy one. What to avoid is relying solely on alerts. Many banks let you set up low balance notifications, which are useful, but they are not foolproof. Notifications can arrive late or be missed in busy moments. A built-in habit, like a cushion or linked savings transfer, works whether or not you see the message in time. Systems matter more than reminders. A better habit is to audit your account once a month. List the recurring subscriptions, bills, and small charges you may have forgotten. Cancel anything you do not actively use. Confirm the timing of large charges. This small review reduces hidden timing risks and quietly closes the cracks through which most overdrafts arrive. Awareness is the cheapest form of overdraft protection. Over the long term, the difference between paying many overdraft fees a year and paying almost none is rarely about income. It is about systems. Households that build small buffers, automate savings, and review recurring charges tend to slowly leave overdraft fees behind. Households that drift along without these habits often pay the same quiet tax to the bank for years. To summarize, an overdraft fee is what a bank charges when it covers a transaction that exceeds your balance, or sometimes when it declines one. The fees are usually large compared to the underlying transactions, often triggered by timing rather than intent, and can be reduced or eliminated through cushions, linked accounts, opt-out choices, and monthly reviews. The single most powerful change for most people is moving from reactive checking to proactive structure, so the account simply cannot fall into the danger zone in the first place. The final takeaway is gentle. Overdraft fees are not a personal failing. They are a system that quietly takes money from people who do not yet have a buffer or a structure in place. Once you understand it, you can step out of it. A small cushion, a linked account, a thoughtful opt-out, and a monthly habit are enough to push these fees out of your financial life. The dollars you save from no longer paying these fees are not small. Over the years, they can quietly fund the very emergency cushion that prevents the fees in the first place, creating a calm and self-reinforcing loop.